If you walked into the close of Friday the 15th of May 2026 and looked at the silver tape, you saw a number that was designed to break your conviction. Spot silver dropped to $77.52 per ounce. That's a brutal decline of more than 10.5% in a single trading session. But here's the paradox. On the exact same week that the paper price of silver cratered, wholesale inflation printed its hottest reading in nearly 4 years, and consumer sentiment plummeted to the lowest level ever recorded since the survey began in 1952. This is cognitive dissonance, weaponized by the financial sector. Every structural, historical, and mathematical reason to actually hold physical silver just got exponentially stronger, yet the paper price collapsed. We're watching a deliberate paper panic attempting to mask a physical shortage, an illusion built to shake the weak hands out of the market. If you're someone who refuses to let the flashing red screens dictate your understanding of global wealth, make sure to hit the subscribe button and give this video a thumbs up, because what I'm about to show you is exactly how the system tricks you into surrendering your real assets. To understand why the paper markets fractured on Friday, we've got to look behind the curtain at how global liquidity actually behaves during an energy shock. The immediate catalyst that triggered the 10% drop on the silver tape was a brutal combination of wholesale inflation data and extreme monetary repricing. When the United States Bureau of Labor Statistics released the April Consumer Price Index at 3.8%, it was already running hotter than the consensus expectation. But the real landmine went off 24 hours later when the producer price data landed. The final demand producer price index advanced a staggering 1.4% in a single month, pushing the trailing 12-month wholesale inflation rate to 6.0%. This is the hottest wholesale reading we've witnessed in nearly 4 years, and nearly 60% of that surge was driven directly by services. In plain English, the input costs for businesses are exploding before goods ever reach the retail shelf, signaling a massive inflationary pipeline that hasn't finished feeding through to the consumer. This is where the psychological trap springs shut. The federal funds futures market took one look at that roasting inflation tape and completely rewrote its playbook. In a matter of 7 calendar days, the market shifted from pricing in 2 interest rate cuts for 2026 to assigning a near 0% probability of any rate cuts this year. Even worse, the probability of an actual interest rate hike by December climbed to approximately 50%. Think about the sheer speed of that shift. The market repriced more than 30 percentage points of monetary risk in a single week. When the perceived cost of holding non-yielding assets spikes so violently, institutional algorithms dump paper contracts across the board to chase yielding government debt. The benchmark United States 10-year Treasury yield surged to 4.59%, its highest level since February of last year, while the 2-year yield weaponized itself at 4.09%. The paper market reacted exactly how it was programmed to react, treating silver as a mere line item on a spreadsheet rather than a finite physical resource. But this entire setup is a massive historical bluff. If you look back at the late 1970s, you see the exact same policy illusion playing out. Central banks desperately try to fight supply-side inflation, which is driven by energy shortages and structural deficits, using demand-side tools like high interest rates. It's an engineering failure. You can't print physical silver out of thin air by raising interest rates, nor can you drop the price of oil by making credit more expensive for small businesses. Raising rates merely creates a brief artificial window where paper asset liquidation makes the dollar look strong. The United States dollar index firmed up to 98.5 into the print, acting as a massive temporary headwind for precious metals. That's what pulled the silver spot price down by $9.21 in a single day, dragging gold down 1.83% to $4,564 per ounce, and blowing the gold to silver ratio wide open from 53.6 to 58.9 in a 24-hour window. It looks like a rout on the screen, but historically this is the exact volatility that precedes a systemic breakdown. The macro tape is being driven by a much darker structural reality, which is the complete choking of global energy and trade corridors. West Texas Intermediate futures for July rose above $113.50 per barrel on Friday, securing a 10% gain on the week, while Brent crude strengthened past $116 per barrel, trading far above the pre-conflict baseline of $60. The Strait of Hormuz remains operationally closed, with daily vessel transits dropped to a mere fraction of the normal 140 ships that used to pass through before the conflict erupted on the 28th of February. The International Energy Agency has already warned that the global oil market will remain materially undersupplied through October, even if a peace agreement is signed tomorrow. To make matters more severe, Saudi Arabia has formally reported to the cartel that its production has plunged to the lowest level seen since 1990. The onshore oil-on-water inventory buffer has been completely consumed. This energy shock is an unguided missile aimed directly at the heart of the global economy, making hot inflation an absolute certainty for the foreseeable future. While the energy fires burn, the geopolitical landscape is settling into a permanent gridlock. The much-anticipated 2-day state visit to Beijing yielded virtually nothing for the Western alliance. Beyond a superficial commitment from China to purchase 200 Boeing aircraft, there were no breakthroughs on the items that actually dictate industrial survival. The discussions left the critical issues completely unresolved, from the flashpoint of Taiwan to the rare earth export restrictions Beijing implemented back in October of 2025. The Western business leaders who traveled with the administration were treated to a lavish state banquet, but they walked out empty-handed. China still holds the ultimate leverage. They control the rare earth supply chains, they dictate the flow of critical semiconductors through companies like Nexperia, and most importantly for our discussion, they hold massive physical silver inventories that are entirely insulated from Western paper exchanges. When you look at the physical landscape beneath the paper panic, the disconnect becomes absurd. While retail investors were panic selling their exchange-traded funds on Friday, causing a massive paper liquidation, the actual physical vault data tells an entirely different story. The London Bullion Market Association reported that total silver holdings in the Loco London vault system stood at 27,454 tons at the end of April. That's roughly 882 million ounces. While that sounds like a massive number, it represents a continuation of a devastating long-term drain. The London Silver Pool has systematically bled out 7,000 tons of physical metal over the last 5 years since its peak in January of 2021. Across the Atlantic, the structural picture on the COMEX is even more dangerously stretched. Registered silver, the actual deliverable inventory that backs the entire futures exchange, sits at a microscopic 79.88 million ounces. The delivery coverage ratio is running at 13.4%, marking its 7th consecutive month below the critical 15% stress threshold. This means the paper-to-physical leverage on the exchanges is currently a ticking time bomb. The Silver Institute and Metals Focus have already projected the global silver supply deficit at 46.3 million ounces for 2026, marking the 6th consecutive year of structural shortfall. Total global supply is forecast to contract by another 2% this year, while global industrial demand remains stubbornly locked above 650 million ounces annually. The market is screaming for physical metal, which is why we continue to see intermittent backwardation in the front-month contracts. That's a textbook signal that immediate physical buyers are willing to pay a premium for spot delivery because they can't trust the paper pipeline. We saw this exact stress break wide open in the first week of January, when 33.45 million ounces of silver vanished from COMEX warehouses in a single 7-day period, representing over 26% of the registered inventory obliterated in one shot. The institutional smart money understands this vulnerability perfectly. While the iShares Silver Trust experienced massive net paper outflows, the Sprott Physical Silver Trust, which holds fully allocated bullion stored safely in the vaults of the Royal Canadian Mint, has seen persistent institutional accumulation. The institutional buyers aren't looking at the daily paper price fluctuations, they're looking at the math of the vault drawdowns. They're positioning themselves for the moment the paper market fails to deliver physical metal, an event that will mirror the classic margin call panics of 1929, where everyone holding a paper promise suddenly realizes there's nothing left in the vault. To compound this immediate physical squeeze, the Indian government unexpectedly doubled its import tariffs on precious metals from 6% to 15% on May 13th, delivering a massive, sudden regulatory shock to one of the largest physical consumption markets on the planet. Look at the psychological battlefield that's been created. The retail consumer is absolutely terrified. The University of Michigan Preliminary Consumer Sentiment Index just printed a reading of 48.2, the absolute lowest level recorded in the 74-year history of the survey. 1/3 of consumers explicitly cited exploding fuel costs, while 30% blamed escalating tariffs. Long-run inflation expectations have crept up to 3.4%. The average consumer is feeling the absolute crushing weight of an economy where retail sales are softening across furniture, automobiles, and department stores, while basic survival costs are skyrocketing. Industrial giants like Whirlpool are already reporting appliance demand levels that their own leadership describes as recession-level lows. This raises the very real possibility of temporary demand destruction on the industrial side of the silver market, giving the bears a talking point to argue that silver could break below its $70 consolidation boundary and retest the high 60s. Now let's talk about what happens next week. Looking closely at the data layout for the upcoming trading session, we're likely to see the continuation of this artificial paper compression before the real physical floor asserts itself. The algorithms are currently dominant, fed by the hawkish repricing of the Federal Reserve and the absolute terror surrounding the upcoming June monetary policy meeting under the newly installed hawk, Kevin Warsh. Because the technical damage on Friday was so severe, breaking through key moving averages with a 10% drop, we should expect to see continued technical selling and paper liquidation early next week. The paper price may very well test the $76 to $74 liquidity pockets as leveraged longs are forced out of their positions by broker margin calls. However, don't mistake this technical cleanup for a structural trend change. As the paper price drops early next week, the premium for physical bars and coins will disconnect even further from the spot price, exactly as it did during previous liquidity crises. By midweek, the absolute reality of $116 Brent crude and the total lack of progress in reopening the Strait of Hormuz will force commercial buyers back into the physical market to secure industrial supply before the pipeline dries up completely. The extreme backwardation on the front month will deepen, signaling that the paper sell-off has reached its mathematical limit. We predict that after an early week washout designed to scare retail holders, silver will stabilize and build a massive base of support around the $75 level, setting up a brutal counter squeeze as the marketplace realizes that not a single ounce of real physical silver was created by Friday's paper panic. When the dust settles on Friday's tape, you're left with a fundamental choice. You can believe the paper illusion, the flashing red numbers that tell you an asset with a 6-year structural deficit is somehow worth less today than it was yesterday, or you can believe the physical reality. Throughout history, every single fiat system has eventually tried to paper over its physical shortages with financial engineering. They suppress the paper price to prevent a systemic panic right up until the exact moment the vault is undeniably empty. The algorithm sold 10% of silver's paper value on Friday, but they didn't pull a single new ounce of the metal out of the ground. If you want to survive the coming reset, your job is to separate the noise from the math. When the paper system finally burns, only tangible assets survive. Don't just take my word for it. I don't want you to blindly trust anything you hear on the internet. Every primary source I cited tonight, from the London Bullion Market Association vault data to the producer price index print, is linked in the description below so that you can clarify this for yourself. Pull the reports, look at the numbers, verify the math. If this changed how you see the system, subscribe and leave a comment below. The data is out there. Your job is to read it. The Asian guy will see you tomorrow with the next update.